Welcome, ladies and gentlemen, to our regular 6-minute strategy update from me, Guy Monson. This session is entitled The World in 8 Charts, and I'm going to take you on a whistle-stop tour, updating you on the economic progress and positioning of the major economies around the world. In Europe, the big issue is the resurgence in the pandemic. I'm afraid the challenges that's going to mean for lockdown and hence the impact on the economy. In the US, we're 39 days away from the election. The underlying economy is looking a little better, but there's great political tension over a fourth rescue package that would protect incomes in the fourth quarter as current measures expire. In China, the numbers are particularly good. We're actually going to record positive growth in 2020. And there's, of course, the impact of the big climate announcement that was made earlier this week. Finally, in the UK, the pivot from the furlough scheme to the job support scheme, what does this mean for long-term growth? And I'm afraid also the current state of the Brexit negotiations. Let's start with slide 2 with a COVID update. First of all, our regular stringency index, how tight is lockdown? You'll see there's a big variation now. The UK, Spain, and increasingly Germany at the top. The UK gone from one of the laxest regimes to one of the toughest regimes, and a big move down by the US as effectively they allow higher infection rates, but encouragingly lower hospitalization rates. That's going to have an impact on the economic numbers. I show here the composite PMI. This is the sentiment of business above 50 is positive. You can see that sharp rebound, led interestingly by the UK, sharpest down, sharpest up, but beginning to fade around the world as some of these COVID-related and political-related concerns come into play. In the US, the elections are going to dominate, 39 days to go. Just to look at what happened to the stock market in the last election as we ran up to the critical Hillary-Trump vote, down and then a rally on the Trump victory. And just remind you again of the Bush-Gore results, where, of course, we had that 1 month of uncertainty over the Florida count, which hit markets so hard. On the right, I've just shown you how many states actually begin their postal vote count only on election day. And in general, Democrats tend to vote by post more than Republicans. So it's just possible that Trump declares victory on the day, only for the postal votes to be counted and his position to be reversed. That's a big uncertainty issue for the underlying markets. Let's jump now to China, where their zero tolerance, if you like, of COVID infections has allowed, after a tough start, mobility to recover strongly and the economy to rebound. Look at industrial production, actually up 5.6% year on year. Yes, retail sales and fixed asset investment are weaker, but as you can see on the right, the overall hit to the economy has been relatively modest. Indeed, we expect the Chinese economy to report actually positive growth in 2020. Remarkable. By contrast, the euro area has been hit much harder. We're expecting a fall of 8.2% in 2020, a little better than when I reported these numbers a month or two ago. But alarmingly, infection rates are rising against a background where on the right, inflation is negative, minus 0.2% Eurozone CPI. Now, yes, that's been dragged down by the yellow bar's energy, but it's still a worrying position. In the UK, the rebound has actually been quite robust, led by a very strong consumer. Look at all retailing ex-automotive fuel and all retailing actually 4 or 5% above where they were a year ago. Extraordinary, really. I'm not sure how long that can last because the rebound in incomes led by furlough is beginning to fade, and you can see real wages on the right starting to go negative. And of course, we've just heard an announcement from Chancellor Sunak that he'll move from a furlough scheme to a much cheaper job recovery scheme, which will mean that there will only be payments for people working at least a third of their working hours. Much cheaper and more affordable, better long term, but some impact in the short term. The second worry in the UK is that sentiment regarding Brexit is hitting capital investment hard. I'm afraid the Bank of England warned again on the left there about falling investment intentions by businesses across Britain. So a brutal 2020, I'm afraid, down 9.6%, but some glimmer of hope in the stronger than expected recovery of the last month or so. What does this all mean for markets? Well, I think the resurgence in the pandemic, the tension over the US fiscal support plan have all hit markets. Global equities down round about 3 to 4% over the week. But for a sterling investor in blue, still positive 3% for the year to date. Gilts have rallied, gold off with the stronger dollar, but look there in the yellow line, the heavy pressure on UK equities, not an area that we're particularly focused on, I'm glad to say, as a global house. All of this on the right has contributed to higher volatility numbers, but not yet alarmingly so. Let's end on a good note, an extraordinary announcement from China, reconfirming their Paris goals of CO2 emissions peaking by 2030, but adding a new pledge of carbon neutrality by 2060. Extraordinary. Add that to the EU's ambitions and to Biden's ambitions, and let's hope that a new green economy triggers the most powerful capital investment program since the Second World War and is the engine of a much more sustainable, longer-term global recovery. Thank you.